This video is sponsored by Skillshare. Visit sksh/theplainbagel3 to start a free 2-month premium trial. If you watch investment news channels, you've probably noticed scrolling tickers or side panels displaying numbers related to commodity prices. For example, you might see gold futures listed around $1,500 or oil futures trading near $55. These numbers don't represent the current market price of the commodity itself. So what exactly are they? Are they predictions of where prices will be in the future? In a way, yes. These numbers are tied to financial instruments known as futures, a type of derivative security that involves agreeing today to buy or sell an asset at a specific price on a future date. Futures contracts were originally designed to help producers and businesses control costs and reduce uncertainty in their operations. Over time, however, they have grown into a major part of modern financial markets. Investors and traders now use them for many different purposes. While futures can appear complicated at first, they can significantly influence the way an investment portfolio behaves when used strategically. So in today's Clean Bagel, we'll break down what futures are, how forward contracts relate to them, and why people choose to use these financial tools. To understand the idea more easily, imagine you run a small bakery that specializes in bagels. You sell a dozen bagels for $6, and for simplicity, let's assume the only ingredient you need is flour. Each batch of flour costs $4, which means your gross profit on every dozen bagels is about $2. Not bad for a small bakery. However, the price of flour is extremely important for keeping your business profitable. If the price of flour suddenly rose to $6 per batch, your profit margin would shrink dramatically and your business would face a serious challenge. Because you're a careful and forward-thinking business owner, you decide to contact a flour producer and negotiate an agreement. In this agreement, you promise that 1 year from now you will buy flour from them at a fixed price decided today. By locking in that price ahead of time, you protect your bakery from the risk of rising flour costs in the future. Of course, there's a trade-off. If flour prices fall instead of rising, you would still have to buy it at the higher agreed price. But the benefit is that you gain certainty and can focus more on running your bakery instead of constantly worrying about market fluctuations. This arrangement closely resembles how a futures contract works. A futures contract is a derivative agreement where two parties commit to completing a transaction involving an asset at a later date, but with a price that is determined today. The price agreed upon today is known as the forward price. The person taking the long position agrees to purchase the asset at that future price. In our example, that would be the baker. The person taking the short position agrees to sell the asset at that same predetermined price, which would be the flour supplier. Once a futures contract is established, both sides are obligated to follow through with the agreement when the contract reaches its delivery date. This obligation remains regardless of whether the deal ends up being profitable or unfavorable for either party. Although these contracts originally helped businesses hedge risks such as fluctuating production costs, they are now widely used by investors and traders seeking exposure to price movements across many different markets. Today, futures can provide access to a wide range of assets. Traders use them to speculate on commodities like crude oil, orange juice, precious metals, and even livestock. Futures are also available for financial assets, including individual company stocks, government treasury bonds, major stock market indices like the S&P 500, and even digital assets such as Bitcoin. Because of this variety, futures have become an essential part of the global financial system. So how exactly do futures allow traders to benefit from potential price increases? Let's walk through a simple example. Suppose you believe the economy may enter a recession soon, and historically investors tend to move money into gold during uncertain times. This increased demand could push gold prices higher. At the moment, the spot price, meaning the current market price, for 1 ounce of gold is around $1,500. Instead of purchasing and storing physical gold yourself, you decide to participate in the futures market. There, you find a contract that allows you to buy 100 ounces of gold 1 year from now at a forward price of $1,550 per ounce. The reason this future price is slightly higher involves several economic factors, including inflation expectations, interest rates, storage costs, and the potential income that could come from holding the asset. Generally speaking, assets that are beneficial to hold, such as dividend-paying stocks, may have futures prices that are lower than their expected future spot prices. On the other hand, assets that are expensive to store or maintain often have higher futures prices. For example, livestock requires feeding and care, which adds ongoing costs. By agreeing to buy such assets in the future rather than owning them immediately, investors avoid those carrying costs until contract date arrives. The price of a futures contract is also influenced by the costs associated with holding the underlying asset. When someone takes the short side of a contract, they effectively take on certain responsibilities, and the futures price generally reflects compensation for those costs. In fact, there is a detailed financial formula used to determine the theoretical forward price of a futures contract. Exploring that formula in depth could easily take an entire video on its own, so for now we'll stay focused on the basic idea. Returning to our earlier gold example, imagine you decide to take a long position in a futures contract. This means you agree to purchase 100 ounces of gold at a forward price of $1,550 per ounce, bringing the total contract value to $155,000. Whether you make a profit or a loss depends on the actual spot price of gold when the contract expires 1 year later. If gold rises to $1,700 per ounce, you would earn a profit of $15,000 because you would effectively buy the gold for $155,000 and could sell it in the market for $170,000. However, the opposite scenario is also possible. If the spot price falls to $1,400 per ounce by the time the contract expires, you would experience a loss of $15,000. In that case, you would still be obligated to buy the gold at the agreed price of $1,550 per ounce even though the market price is lower. This illustrates how futures contracts lock both parties into the agreed transaction regardless of how market prices move. Now imagine you have a different outlook on gold. Instead of expecting prices to rise, you believe they will decline. Perhaps you think an economic slowdown will prompt governments and central banks to stimulate the economy, which might encourage investors to move money from gold into equities. If that happens, gold prices could fall. In that situation, you might choose to take a short position in the futures contract, agreeing to sell gold in the future at the predetermined price. If the price eventually drops below $1,550, the short position becomes profitable. You could purchase gold at the lower market price and fulfill the contract by selling it at the higher forward price you previously locked in. Essentially, the profit potential reverses depending on whether you take the long side or the short side of the agreement. At this point, you might wonder about the practical side of things. After all, managing the delivery of 100 ounces of gold isn't something most individual investors can easily handle. And if you had taken a short position, you might ask where you would even obtain that much gold to deliver. Gathering a few small items from a pawn shop probably wouldn't satisfy the requirements of a professional exchange. Fortunately, many futures contracts are structured so that physical delivery never actually takes place. Instead, they are settled in cash. In a cash-settled contract, no physical commodity changes hands. Instead, the difference between the agreed futures price and the final market price is simply credited or debited from the trader's account. This approach makes futures much easier for investors to participate in without worrying about storing or transporting physical goods. Another feature of futures markets is that you do not have to wait until a contract reaches its expiration date. Investors can exit their position early by taking the opposite side of the same contract. For instance, if you originally entered a short position on a gold futures contract, but later decide to close the trade, you can open a long position on an identical contract with the same asset, quantity, and delivery date. The two positions effectively offset each other, and your gain or loss would equal the difference between the prices at which the contracts were opened and closed. This ability to close positions easily exists because futures contracts are standardized and traded on organized exchanges. The standardization means that contract sizes, delivery dates, and asset specifications are predefined. As a result, traders can easily find buyers and sellers for contracts, such as a commonly traded 100-ounce gold futures contract, through their brokerage platforms. There's another type of agreement called a forward contract that is similar to a futures contract but slightly different. Forward contracts are privately negotiated between two parties rather than traded on a centralized exchange. Because of this, they can be customized to include any quantity of the asset and unique terms. However, forwards are most often used by companies that want to hedge business risks, so they are less common among individual speculators. Although futures provide a convenient way to gain exposure to commodities and other assets, they also carry significant risks. One major factor is leverage. Futures trading typically requires only a small portion of the contract's total value to be deposited up front. This initial deposit is known as margin, and it allows traders to control a much larger position than the amount of money they actually invest. For example, in the $155,000 gold contract we discussed earlier, your broker might only require an initial margin of 5%. That means you would only need about $7,750 in your account to open the position. While this structure makes trading more accessible, it also magnifies potential losses. If gold prices drop sharply to $1,000 per ounce, the loss on the contract could reach $55,000, which represents an enormous loss compared to the original margin deposit. Because of this leverage, futures trading is generally considered unsuitable for inexperienced investors. Despite appearing straightforward at first glance, these instruments have a wide range of uses and complexities. Futures can provide exposure to specific markets, but they can also be used strategically to reshape the overall risk and return characteristics of portfolio. In some cases, investors use them to reduce market risk or lock in returns on certain positions. Futures prices can also offer insight into how the market collectively views the value of an asset over time. Traders often examine something called a futures curve, which is a chart that displays the forward price of an asset across multiple contract expiration dates. This curve can reveal expectations about how prices might evolve in the future. For example, gold futures often show an upward sloping curve, meaning contracts with longer expiration dates tend to have higher prices. This suggests that buying gold further in the future usually costs more than buying it sooner. However, the shape of the curve can change as economic conditions and market expectations shift. Natural gas provides another interesting example. If you look at its futures curve, you may notice a repeating pattern. This happens because natural gas demand is strongly tied to the seasons. During colder months, consumption increases as people use it for heating. As a result, futures prices for winter delivery periods are typically higher than those for other times of the year. As you can see, futures prices can reveal a surprising amount of information about how markets function and how investors anticipate future trends. While we have only touched on the basics here, the goal is to provide a broad understanding of how futures contracts operate. In reality, they are rarely a standard component of a typical investment portfolio, and anyone considering trading them should take the time to study the subject carefully before getting involved. So the next time you notice one of those small numbers scrolling across the corner of a financial news screen, take a second to think about what it represents. That tiny figure isn't just another statistic. It reflects expectations about the future price of an asset and offers a small window into how markets anticipate what may happen next. Thank you for watching. If you enjoyed this video, be sure to press the like button. And if you appreciate the content we create here, consider subscribing to the channel. Don't forget to enable the notification bell so you can be alerted whenever new videos are released. If you have any suggestions, questions, or topics you'd like to see covered in a future episode, feel free to leave a comment below. For the Plain Bagel, I'm Richard Coffin. Thanks again for spending some time with me today. This video is sponsored by Skillshare. As the name suggests, Skillshare is a platform designed to help people learn and improve valuable skills. It provides access to thousands of classes covering a wide range of subjects. I've personally used the platform for quite some time, both to improve the quality of this channel and to explore a few personal interests outside of it. Recently, I've been spending more time learning graphic design. With the channel growing and approaching the 100,000 subscriber mark, I realized it was probably time to improve my design abilities. One course I've been following is called Customizing Type with Draplin, Creating Word Marks at Work. The class focuses on modifying and refining typography to create strong, effective word marks, and it offers practical guidance for anyone interested in design. If you're more interested in financial education, there are also courses that cover the basics of investing. For example, Investing 101, Understanding Stocks, walks through the fundamentals of stock investing and explains key concepts like financial ratios and essential metrics that individual investors often use when evaluating companies. Beyond those examples, Skillshare includes classes on a huge variety of subjects. Whether you're interested in painting, creative writing, coding, data analysis, or countless other topics, there's likely a course available to help you get started or improve your skills. If you'd like to explore the platform yourself, you can try it free for 2 months by visiting sksh/theplainbagel3. Using that link gives you access to a free trial of Skillshare's premium membership, which normally costs around $10 per month, and it also helps support this channel. So whether you're hoping to strengthen a professional skill or simply want to experiment with something new, I definitely encourage you to take a look at Skillshare.